This is Eric Mwatha with Mwatha.com. In today's educational video, I wanted to take a look at a world market. The reason being that it's always good to see whether some of the principles we use are universal or whether they work for just the US market. It's obvious that if the principles are correct, then everything should be reflective in all world markets. Needless to say, let's take a look at the New Zealand stock market going back to 1999. And you can go ahead and ignore all the lines you see on the chart here. Those ones are meant for me so I don't forget some of the key points I want to talk about. We are going to begin with a very key number here. Now, first and foremost, the one thing you'll always notice in my educational videos is I tend to spend a lot of time on monthly charts. The reason being that, quite frankly, if you spend too much time on daily charts, you tend to miss the big picture. On the other hand, when you consider the monthly charts, they seem to bring some clarity, and also they give you reason to stay in a stock or in a trade longer because you see something developing, or they help you stay out of a stock for years. If the conditions are not there to buy a stock, why buy it? And so that's why you'll notice that, as far as I'm concerned, monthly charts are probably the most important chart setting, then followed by weekly, then daily. But if I was given a choice, I would probably go with a monthly chart and just forget about the rest of them, given a choice. But since we have all these tools, I think that monthly should be your default chart setting. Maybe your weekly, that's fine, but dailies, not so much, unless you're really a day trader, when you want to look for in and out situations. This is a long-term monthly chart for the New Zealand stock market. Again, the key here I want to talk about is this level 61.8, and this is a Fibonacci number. It's called also, I think 1.618 is called the golden ratio, golden mean. It's all Fibonacci numbers. And the reason why I like this is when you start putting a consideration of this number here, you'll start seeing that it shows up everywhere. And if you really want to make money in the stock market, try and find stocks that are moving above 61.8 for the first time in at least 3 years on the monthly RSI. You can see here on this chart, this stock market would eventually break out to new highs here. So the ultimate Mwatha breakout tells you to buy when a stock makes a new high. Number one, we're already trading above 50. So the psychology is bullish, which would have got you in the market somewhere here in 03. Now, if you notice, there was a small blip and then down and then up. In other words, here in mid-2003, the market would move here about 60, go down, and then break out above 61.8, which is this entrance there. Now that corresponds with this breakout here above this level, which brought you to new highs. So even that was a good, decent breakout. But what is important here is the fact that once we moved above 61.8 for the first time, which is this move here, you can see the accelerated jump. In other words, the move is powerful. It's just not a everyday move. And this markets don't move as much, but you can see this was a strong move in the market. Why? Because we are moving above 61.8 for the first time. Now, by the way, I hope you've already watched my other educational videos, because this is a summary of all those ideas. So I would urge you to watch the other videos first before you come to this one, because this one is just a rehash. And if you already understand the principles, then this is not going to be as useful. But it's just a rehash and a meshing together of many educational points. So we get this move. We get this big move from 03 to 2007. Most of the world markets were on fire. I have to say this instrument here was on an accelerated move to the upside. And I believe it's because it moved its RSI above 61.8 on a monthly for the first time. I'll also go ahead and show you the MACDs in 2003, and so that we can know that our ultimate Muade breakout is solid. Notice that the MACD breaks out. Remember, that's the other requirement, breakout to new highs there. That never fails, and another breakout to all-time highs on the MACD. All this in mid 2003. Okay, so the ultimate Muade breakout is solid. That is not even in debate. So 2003, mid 2003, all those factors tell us to go along the Australian market. Okay, there was also another price. A lot of people use the price buy point, which also worked here. If you take the highs on a closing basis, remember there was a closing high there. You want to use the closing price because that's the legit price. Intraday action, not as solid, but the monthly close, daily close, weekly close are more, let's call it, where everything's settled. And so use those as opposed to using intraday action. So we take the monthly highs, draw a straight line, and see the entry point was here. Still, good entry point. Like I said, also you could have taken the breakout after this drop here. This breakout to new 52-week highs here was also another entry point if you just use price by itself. But you would not, if you would have used price by itself, you would not have been able to tell the velocity of the move down the road. But if you use our principle, you would have known as we blasted to new highs on the RSI, which is a measure of sentiment as by my research, then you would have known there was a big move. You would have had the opportunity to know that it's time to bet big, bet on speculative plays, because this market was pushing everything higher. Remember, 75% of a stock's move is based on market direction. If you get the direction of the market right, then you can really play and hold for long term, because you know there's a lot of money to be made, a lot of money. Now, as this market moved higher here, I want to, you see that it made incremental highs in the price, but yet over a couple of years the technicals kept dropping. Now that was a red flag. It took many years to eventually break the back of that rally, but that's one of the requirements for major highs. It always seems like all major highs have that same feel, where you have improving new highs in price and declining sentiment. Those two things tend to break charts. One thing I wanted to point out here is whenever a stock is moving higher, like we can see, the RSI went up, came down, and so some people want to sell. Man, that's fine, but you have to understand how this works. And it's very hard to explain, because sometimes that happens. Like the high would have been in 05, which is, let me take that off. As you can see there, most technical analysis books, if not all of them, tell you to sell when the stock is oversold. Like here, sell it here. But you can tell that was not the high. The market would make new highs over many down the road in years' time. In about 2.5 years down the road, the market was still making new highs. The thing about it is your high is going to come in when you have this negative divergence, declining technicals, improving price. So don't look at this sell point on the RSI. Now, the other thing also to be very aware is whenever you see a stock that was on fire, a market that was on fire, and the RSI comes down, tries to break 50 and immediately recaptures it, like it did here, right? You see that it immediately recaptures 50 right there and stays above 50. That market is telling you, hold on. That market is telling you that it is going to make another high. It has refused to break down. Okay, it's found support on the 50, immediately rallies back. That's a market that wants to make another high. Okay, so even though you know that the technicals are declining, you know that it's going to push again, and even with the declining technical strength, it's going to make another high. Just understand that whenever a market recaptures the 50 after a strong rally, that market is going to new highs. It's just it's as the more you observe it, the more it becomes real. Okay, now also you'll notice that if we had taken the lows there, that low, this low, that low, over many years, and drew a straight line, we would have known that that was the line that if that market ever broke below that line, that was time to get out. Okay? Just, it's as simple as that. Once that is broken, that's a long term, because this line, this blue line I'm drawing here, kept the market higher. As the market stayed above the blue line, you can see that it just was on a multi-year rally. Now, once it broke down there, that corresponds to this trend break also in price. Here we are taking the closing low there, draw a straight line. Once we broke down there, that was time to get out. It also was when we broke down on the sentiment, get out of that market and wait for things to settle down. And if you had sold there on those simple principles, you don't have to go and read tons of research and all that stuff. It's keep it as simple as you can. You would have avoided the crash of 2008. All right, now we saw that crash and I put out a warning just based on simple things like that things were not going to be good in 2008. And it's not because I'm a genius, but the market was breaking previously strong trend lines. Okay, now there was also another break, and the reason why you see this accelerated move here is because we made a 3-year high. Remember, we make a 3-year high, things move higher. We make a 3-year low, which is here, 3-year low in the lowest RSI level here, corresponds to this. Actually, it was here, this move from here to here. Why? Because we made a 3-year low, and so that now the technicals, once we moved above to 3-year highs, all-time highs here, we blasted to new highs. Okay, now notice we move below here. Okay, and we also crash below 38.2. Now that's the opposite number from 61.8. 61.8. You know, the two of them give you 100%. So this is just another way. You flip the chart, this becomes 61.8. But if you just keep it the way it is, 38.2 is also another important number, because notice not only were we moving to 3-year lows here, we were also crashing below 38.2. Another important number. All right. So I'm just pointing out things here that we need to know. Also, it's important to note here, because whenever you see your MACDs after years and years of staying above zero or below zero, whenever you see this move below zero for the first time in many years, and also a trend break here, okay, you really have to be very careful. There was also another trend break here. These are important things. Even if you stay in a trade, you just know you're staying in a trade, but you shouldn't, because it's not going to be pretty. Now, another thing to observe here is, if you had kept this line here that gave you negative divergence and just kept it there, you'll see that this line, eventually, once we broke out above it, which is about 2012 here, which is would have got you in the stock somewhere here. It wasn't a perfect buy signal, because the perfect buy signal happens to be when we draw a line connecting that high there, and also happens to be where we move above 61.8 for the first times in more than 3 years. Again, so the same thing, but now to the upside. Once we broke out there, which is this level here, once we broke out, that was a move, breaking out of this RSI top lines, breaking into 3-year RSI highs, and also, so we have a wedge here. It's a lot of information here. We have a wedge here, and we have a lower wedge here. Once you break out of this multi-year trend line, blast, you get the strongest move. What I'm trying to teach here is that the strongest moves in a market come when certain things take place. Okay, so we have a RSI moving to a 3-year high. moving out of a wedge, all these things. And also, I guarantee you the MACDs were also making 3-year highs, because that's how it happens. The ultimate Muade breakout is solid. It is well researched. Notice that the MACDs are making 3-year highs on Q. And because of those developments, you get the strongest move in the stock. Now, there's something I want to point out here is you take the lows here, draw a straight line, the lows of the early 2000s, draw a straight line. You see that the next time this instrument hits that top, this could be a high. It's just something to watch. Man, I would not really be in a rush to sell in this kind of a market, because even though this could be a sell signal, because now we've broke down here and we've taken years to come and hit that underside of that line, that typically is a sell signal. But I'm not really desperate to sell. Why? Because this market is still trading above 69.10. So it's still in a strong market. So even if I would sell later, maybe I sell it at 150 here, I'm still giving a chance to rally. The bottom line is I'm in a market that is already giving me a Muade breakout, ultimate Muade breakout with that move there. So what I really want to enforce here is the idea that you want to find markets and stocks that are especially, and this is important, moving out, breaking to 3-year highs, all-time highs, and especially if the breakout is taking place around 61.8. This is a major universal low. I believe it is a low. If you want to make money in the market, wait for this breakout around that 61.8. Now, there's also something else I want to point out pretty quickly here is anybody who was playing low, this bounce here, this low, and this low, once we had this low here, okay, and then we had another low, so you get 2 points, and now you can draw your line. Now you would have missed that because we needed 2 lows for this to take place. So once you get, hope I'm not confusing, you need 2 points to draw a straight line. So that point, draw a straight line. You would have been able to recognize that was a low in the market because it hit that level, and that was another low here, which is this area here. So there's also other ways to play the market, not just the breakouts, but just keep it simple on the monthlies, and you start seeing things develop. You have a sense of where the market is going. You don't have to be tied down to everyday news and all these complicated factors that market throws at you. So the video is just a rehash of many things we talk about, and I'm sure there's so many things we can talk about on this video. For example, take a look at the fact that every time you have the crossover between the 10-month moving average and the 21-month moving average, you get a buy signal there. You got a crossover between the 21-month moving average and the 10-month moving average, you get a sell signal. The next time you have a major crossover is here and here, and in both times you can say your market still gave you a buy signal. Okay, now there's one thing I want to point out here is, notice this is important, is look at the 21-month moving average. It comes down, so it makes a low, tries to break out, tries to recover, fails, and then blasts out. You want to recognize that now, because it's making a new multi-year high on the 21-month moving average, then that is a more legit crossover. In other words, this crossover here is not as powerful as this crossover here. Why? Because here's the thing, is whenever you see an instrument like the MACD or the moving trend lines like the 50 days and the 150-day moving average, all these price trend lines, is most people think that once they coil around, they go down and they start moving high, that was the low. It sometimes is, but what you really want to do, for example, take a look at how this crossover was smooth here. That was a sell signal, especially when they're very sharp. But notice in this example here, there was a crossover here that failed. So what you do once you see a failed crossover, what you want to do is you want the moving averages to come and break out above that level. Then that becomes a legitimate entry point. They failed to cross over here, okay? Markets didn't go up at the time, but once you come, the instruments, the moving averages come back and break out, that's the more legit entry point. In other words, you want a failed crossover, A, to show you your entry point, a failed crossover here. That becomes where you need the market to move above. Once the trend lines move above that former failed level, that's your entry point. It failed here. Once it comes back and the moving averages cross over, not the price, the moving averages, that's where you want to go in. That's a more powerful crossover. It also happens on the MACDs. For example, you notice the MACDs were trying to made a high here and another high here, which you can draw a line. It's only when the MACDs broke out here that gives the strongest move in the chart. Okay, for example, take a look at this low here in 09. It tried to cross over here, failed, tried to cross over here, failed. So your entry point is when it moves above those failed breakouts. That's my point. That's where you go in, and that's 2009. That would have given you a nice move in the stock. So you would have gotten the stock here, which happened to be the low. If you are somebody who was managing money for a large fund, you aggressively buy stocks there and hold them for the next 5-10 years because you know you got it right. That's my point. Notice again, even the RSI tells you it tried to recover here, failed, came down, tried to recover here, failed. So the next time you move above those failed points, it even gives you another buy point. In other words, what failed, once it's broken, is a more powerful signal. Now, I've talked about a lot of things in this video. It's just a rehash, like I said. This is Eric Muada with Muada.com. As time goes by, I'll keep posting more and more videos so we can understand how markets work. Eric Muada with Muada.com. Good luck, peace, and blessings.